Hello, everyone. Thank you for joining this short market and economic update. I say short, you know me, I've got about 20 slides. I'm going to get through them pretty quick. A lot of them are kind of different data sets to basically say the same thing, to confirm the same thing. So let's jump right into it. First, what I wanted to show is our 5-year income plan. So if you're a client of ours, you are nearing or in retirement, you've seen this 100 times. What I like about our investment philosophy and our investment approach is the proactiveness of it. That we don't wait for things to happen. We're anticipating these things happening. We're preparing for these things to happen. Data tells you the market's going to go down about 10% once, 1.5 times a year. Market's going to go down 20%, about one every 3.5 to 4 years. So instead of trying to react to and be right all the time, we put the work in ahead of time. And I think the work that we're doing around this 5-year income plan has really paid off. And I know that even though we're not having to use it yet, 10% market drawdown is nothing to get crazy nervous about. But traditionally speaking, through 13 years of doing this, market goes down, 10, 12%. Traditionally, we're going to start getting some phone calls, some text messages, some emails, from clients questioning, what's happening? Am I okay? Are we making changes? And over the last 3 weeks of this 10, 12% market drawdown, I have gotten zero of those. So first and foremost, I am so happy and proud of all of you for trusting in our process. We appreciate the trust you're putting in us to not be worried. And I think that a lot of that is the information and education we do, but the vast majority of that is our process, is our philosophy, is our approach that we reinstill into all of our clients every single time we meet. So good on you. Let's keep our eyes open though, because we want to be prepared if this turns into something bigger here. So first, let's just take stock of where the market is currently at. So this is the S&P 500 going back about 3 years after that big drawdown in 2020, quite the recovery. So you can see this little 10% drawdown that we've had. You can see in the top right-hand corner, it's at 8.9% right now. Market down 4.8% year to date. But the total drawdown, you can see it's come up the last few days, was a little over 10%. So what we would classify as a normal market correction. What's interesting is it's come back down to those highs that we saw in July through September of 2024 and kind of found some support there. And we're starting to, only been a couple of days, but we're starting to tick back up here a little bit. So, but by zooming out, you can see, this is, probably more normal. We've been on a really good run here the last couple of years. Same thing with the NASDAQ 100. So this is the top 100 companies in the NASDAQ. Think those big high flying companies of the last, decades, the Amazons, Apples, Nvidias, Microsofts, Facebooks, things like that. They've had a little bit of a bigger drawdown. So they went down almost 15%, still down about 12.4 as the time of me clipping this here on Tuesday morning. So this is just more of a cooling off of those big names just because they've been on even a bigger run. We think this is still pretty normal after having that reaction or that sort of run to have this level of a reaction. This is the 10-year Treasury yield. So the 10-year Treasury yield from the United States government. I've had this trend line drawn in here for quite some time, and it just continues to repeat itself in this, channel that you can see. You can see the midpoint of the channel has some reactionary points, but we're starting to get multiple points on the outsides of the channel, and that's where we find ourselves today at about 4.3%, is at the lower band of that channel. We are, prepared for anticipating interest rates to actually tick back up from here because we've got that track record now for going on for almost 5 years of this channel movement. So until that breaks out of that channel, then we're going to anticipate the interest rates are going higher from here. This is the dollar, the United States dollar. So a longer term look at this. This goes all the way back to 2008. So a really long term channel here. You can see we're kind of in that middle territory. It's kind of hard to see, but I have a little trend line here from 2021 till recently that's a little bit steeper. Maybe we hit that and bounce back up. But the dollar coming down over, basically year to date. Here's a zoomed in look. You can see that channel here on the right, kind of right in the middle of that bottom section, that trend line. You can see the top trend line there in red as well. We've gotten kicked out of that a couple of times. So really going to be a bounce back and forth here, we anticipate, for the foreseeable future. I think we're probably leaning towards this bending back upwards here in the short term. But because the dollar has come down, international markets have outperformed U.S. markets year to date. So the orange line that you see is the S&P 500 down about 4.5%, versus that purple line is the MSCI All Country World Index ex-US, meaning not including any US companies, all international, up about 8.5%. So this is the reason why we stay diversified, right? Our portfolios haven't suffered as much because we have a section of our portfolios, an allocation that is in international markets that have performed quite well year to date. So this is a case for diversification. The challenge, though, is this is a short-term look, and I'll take a longer-term look in a second. This is international versus US. Okay, so if this line is going down and to the right, that is international underperforming, right? If it is going up and to the right, international is outperforming. So you can see year to date down here in this bottom right, international has been outperforming US. However, we've seen bouts of this for a very, very long time. I'm going to jump back again. This is showing you just the last 3 years, give or take 3 years, versus this is showing you the last 14 years. So we've seen little bouts of international outperforming US, several different moments in time, but we've never really seen a significant, movement in international markets. Not to say this won't be it, certainly something to keep our eye on, but not enough evidence to this point to suggest international markets are going to now outpace US markets for the foreseeable future. So definitely stay diversified, definitely have our allocation into international, but it's not necessarily we feel like this is a big move yet. Now, if we break through this green 200 week channel trend line, this is kind of faint, but that's a 200-week average. If we break above that, then that would be a pretty clear change that we'd want to maybe hop on a little bit harder there. So before I go into some specific data sets, I just want to remind you folks where I find all of this data. I didn't source each and every piece, but these are our four main data and research firms we partner with. So FS Insights, Archaea Capital, those are our macroeconomic teams, Sentiment Trader and Thrasher Analytics, more data, proprietary models, risk assets, a lot of data and analytical driven here. So a good combination of the two. All of this data comes from them. So the markets came down, right? How come? If you look at the news, if you read the paper, jump online, whatever it is, like you're going to get thousands of different reasons why. I think the main culprit is the uncertainty around the tariffs. But hear me out here. Maybe it's completely normal. So this is NASDAQ seasonality. Okay. So this is on the bottom. You will see, I'll clear myself out here somehow. On the bottom, you will see the 0, 10, 20, 30, that's the number of trading days we are throughout the year. And then on the left-hand side, the total return so far through that many days. And this is the last 30-year historical average. So you can see the market has historically peaked out at around day 30, cooled off through February, right? And then really started to tick back higher for the rest of the year. So what we've seen over the last few weeks could potentially just be completely normal averages that we see every single year. The next thing is, the economic policy uncertainty index is what this is called. So this is when people sort of lose their, marbles a little bit on certain specific policy issues. So COVID obviously was one of those. The global financial crisis was obviously one of those. And we're labeling this one Trump. I don't know if I like that, but this is more around the tariff uncertainty. I would say that you could throw in some inflation uncertainty and interest rate uncertainty in that. But all the inflation and the interest rates is all going to be somewhat predicated on the ultimate outcome of these tariffs. So there is a ton of uncertainty going on right now. Now, having said that, I don't believe there is more uncertainty in our policy, economic policy today than there was in the global financial crisis, right? I mean, this was a really, really big deal. And so I think this is, as most things typically do, get a little overblown. And I think the where we're at in our world today, with the red and the blue and the 50-50 and the polarization of politics and economic policy is heightening this to unreasonable levels. I think the you can see these are news articles, right? So this is people deciding to write articles about these specific issues, and obviously we're so polarized today that that's what's going to get the clicks, and so that's what you're going to get in your news feed. So I do believe this is pretty well overstated, and I think the best example of that is looking at the global financial crisis, and me finding it hard to say that this is a more uncertain time than it was then. So this is a expected change in unemployment over the next 12 months. So this is, again, just a University of Michigan survey on what people think unemployment's going to do. You can see that during a recession, the survey results get pretty negative, but it's pretty rare for them to get negative before the recession. They obviously ebb and flow quite a bit. It's happened a couple of times, but we are at levels that you see at the bottom of these recessions, right? Not in the beginnings of them or even before they happen. Like this is bottom type numbers of what people think the unemployment rate's going to do. And we're just not seeing that in the data. So again, these surveys, right, is what causing people to make reactions in their portfolio, not the data that we're actually looking for, that we'll get to. Here's another survey. I'm gonna hit on the human element of what's happening in the market pretty heavily here in the beginning. So this is again double A bear. So this is again another survey. Are you bearish? Are you bullish? And you can see these red dots on the chart mark extreme bearish moments in time. Okay, so obviously you have the great financial crisis, the COVID uncertainty, but when they reach these extremely high levels, you can see in the data 6 months later, 100% win rate. The S&P 500, that is up 100% of the time 6 months later for a 30% rate of return, and 100% 1 year later for a 31% rate of return. So not a huge sample set, okay, but what we know is traditionally these surveys do not actually represent the data that's behind the scenes. So people are mega fearful, and that typically happens towards the bottom, not at the top. So all of these people are nervous, right, says the surveys. And so what do? They sell, right? And so we've seen a significant amount of selling, which the market's only come down 10, but you can look over these last few years, the flows out of stocks and into cash. Okay, so this is a metric here that Macro Charts gives us. So you can see we're hitting his green line, which he considers that to be the opportunity to start thinking about buying stocks, and then he draws those red lines in correlation to either at or super darn close to the bottom of these market drawdowns, right? Traditionally, people are either starting to get nervous and fearful and sell, or, they're seeing their account balances, or they just need the money because something else is going behind the scenes. But over these last 7 or 8 years, it's really just been more fear driven. The markets continue to plow ahead, and we anticipate that similar thing happening this time. So definitely something to keep an eye on. But when people are exiting, it's traditionally not the top of the market, it's traditionally the bottom of the market, as shown in this data. Here's another way to look at this. So this is from Sentiment Trader. This is their smart money, dumb money confidence spread. So this is just a metric that they build, that they deliver to us. But essentially what this is doing is following specific types of traders and specific trades that are being placed, and they follow them all the time. And what they do is they separate those into what trades are making money and what trades are losing money. And the ones that are making money, they put in the smart bucket, and the ones that aren't making money, they put in the dumb bucket. And then they reference those against each other to get these swings. But main thing we're looking at here is when the smart money spread gets this high, as you can see represented in all these pink or purple lines here, these were at the bottoms of market downturns over the last several years. This goes back to early 2022. These were market bottoms, not market tops. Okay. And here we are today hitting a super high reading. We'll see what happens. But again, these are not market tops that this is happening. These are the bottoms. Again, on the panic euphoria model, another just reactionary thing to what people are doing with their money. When you can see when the dip gets this low, right, it's traditionally been a pretty opportune time to be buying. This one goes all the way back to 2016, so a little bit bigger data set here. So another good opportunity. This was the fifth fastest 10% correction that the market's ever seen. Okay. So it went down 10% in 20 days, which is the fifth fastest. Looking at all the other times where it took 20 or less days, this was the results 1 year later. So you can see 3 months later, all positive, 6 months, all positive, 1 year later, all positive, 100% win rate. Okay. With an average annual return of 20.8%. So again, all right, this is data. This is people pulling the trigger on selling, right, versus listening and looking at the data and making a decision from there. So another good sample size of opportunity. Now, if you followed our 2025 market outlook at all, you heard me talk about corporate insiders, right? And at that time, we were right about down in here, corporate insiders, so CEOs, CFOs, people in the know, board members, things of that nature, people in the know of what's happening inside of these companies were selling at a very, very large clip. Well, that's started to unwind now, right? Markets pulled back a little bit. Their stocks are looking a little bit more reasonable. They're looking at the data and making decisions. Do I want to buy my own stock, sell my own stock, or hold it, right? The sells are slowing down. We're not necessarily in this super high buy territory, which, as you can see from these pink lines, has indicated pretty opportune times to be purchasing. But the fear is starting to unwind. Something to keep an eye on. We'd be looking for this to get up into that 0.12 or higher, and definitely be a little bit more aggressive in our buying, and maybe even possibly overweight our equity allocations if all the rest of this data comes in supportive. Taking a deeper dive into that corporate insider action, this is corporate insider velocity, right? So not necessarily, how many people are buying or how many stocks, but just the pace of the buying. How quickly did it change? And so this is a really nice sample set going all the way back to 2010 of all the times the velocity or this rapid change in buying happened, represented by all these red dots. All of them have been pretty reasonable times to buy. Again, the most important things are these are not happening at market tops or right before market recessions, right? This is not when these things are happening. And then here's what the data says. We'll look at this green box. Below is all the different times this is registered since 2010. But let's look at this green box. 6 months later, 89% win rate for a 6 and then a 12% rate of return. We're long-term investors. 1 year later, 100% win rate for an average annual return of 21.22%. Okay. And this is in the technology sector specifically, right? So definitely looking, and we are, just so you know, you're getting your trade confirmations. We are leaning more into that large cap tech space that got hit a little bit harder. We're coming out of our quality positions right now, the more blue chipper, good balance sheets, things like that, moving into these more tech heavy indexes, trying to capture some of this opportunity here. Next is the S&P 500 is another just good data, right? What do the numbers say? I don't care what people on TV, right, are trying to sell me or trying to scare me into doing. What does the data actually say? So this is the S&P 500 after closing at a 6-month low. Okay, so we hit a 6-month low in the market, but then we had consecutive 90% up days, meaning out of the S&P 500, 90% of the stocks were positive, right? 2 days in a row. Okay. After a 6-month low. Really nice sample size here going all the way back to 1938. The biggest thing I want to draw the attention to, as long you can see some pretty good data in the 2 to 3 months. So 100% win ratio, 94% ratio. But again, let's focus on that last column on the right. 12 months later, we're positive 88% of the time for an average annual return of 12.3%. Okay. Really, really strong results. Now, the thing that I like the most about this is the 2 times that it didn't happen, right? That we didn't get a positive rate of return. It was minus zero point 0.4 and minus 2.7, right? There is no 15, 20, 25% drawdown after these with a really nice sample size. So again, this is more of a market shock, a market, reaction to uncertainty than it is the economy starting to crumble, if you will. Not to say that's not going to happen 12, 18, 24 months down the road. We just don't believe that it's happening today. Lastly, really nice long-term sample size here. This is my last one. This is from Macro Charts. This is his core risk model. So it plugs all sorts of information into this. Obviously, we're not privy to that. Otherwise, he wouldn't have any information to sell us because we could recreate it. So there's a proprietary model of his that he's been using. And you can see that when this core risk model gets this low, based on those red lines touching that green bar, getting darn close, you can see on the top is the S&P 500. So just a really nice, 15-year sample set here of this core risk model. You can see when we get this extreme reading, right, it has not been the market top. And several times it's been really right at the bottom, or really nice short-term bottoms as a part of a longer-term uptrend. You can see those here in 2013, 14, and 15. They were just little cooling off periods of what was a really, really strong time in the market. But this core risk model also called the bottom in 2011, hit the bottom in 2020, and hit the bottom in 2023 as well, or excuse me, October of 22. So, we're getting another one of those readings again. So what does the data say? Try to ignore the news. Most importantly, process over predictions. We'll keep following our process. We will keep informing you of the reactions and the changes we're making to that data. But we appreciate your time and appreciate you watching. Hope you all have a great rest of your week.